Stock markets shatter records once again. The sensex and the Nifty end at all-time highs on Friday. For the week, Dalal Street posted its biggest weekly gain in a year, with all sectoral indices ending higher. Hello and welcome to Editors Roundtable. On today's edition, we put the spotlight on the big blue chips being downgraded, whether the FPI retreat from China is India's gain, and whether IT can make a comeback. I'm Reema Tendulkar, and with me are the boys, Prashant, Anuj, Nigel, Nimesh. Hi, special Friday, right? Yeah, it's a full house and it's a special Friday.
Absolutely, yeah. And the market's got used to it for the last few weeks. And my sense is that over the next couple of weeks, you'll have almost similar, identical headline, because I think we're headed very fast to 20,000. The slow pace that we had from 18,000 to 19,000, we took 21 months to get to from 18,000 to 19,000. Now this is getting into parabola, melt up, whatever you want to call it. Of course, it's dangerous at times, but I think this market clearly has sensed momentum. And I won't be surprised if the 21 month gets crunched to 21 days in terms of, going from 19,000 to 20,000.
200 points today. So at this rate, but
yeah, 5 days, but obviously, yeah, but
exactly. Sounds nicer, right? 21 months for the, from 19 to 20, so 21 days from, or whatever, 18 to 19. Before we take stock of where we are headed from here, how valuations are looking, quickly tell us how H1 has panned out.
Well, H1 has been good actually for global markets on the whole. Equity markets globally have done well. The Nasdaq, in fact, is up close to around 30%. That's been the poster boy, and it's on pace for its best start to the year, the best in the last 40 years. So that's telling you the kind of party that's been out there. The Nikkei has been an underperformer, but that's come to the party as well. So a lot of those global markets have done pretty well. But India, we normally compare us with our peers. So we're bang in the middle. Compare us with the Bovespa, compare us with the Chinese markets. India has given you returns of close to around 6% in the first half of the year. But it's actually been a tale of two halves. The first quarter, you saw the index was under pressure and the FIs were selling. The second quarter, well, the FIs, they are showing us the big money. And you saw the Nifty as well, that's bounced back in style. So though you'll say it's a 6% gain, what's so special about it? Actually, the second quarter of this calendar year has been a brilliant one in terms of flows as well as in terms of performance. Now, out of this 1,000-point gain, who contributed the most? Well, ITC. A fourth of that has come in from ITC alone, close to 25% of that. And if you just club these top 6 stocks that come up for you on the screen, you have 60% of the returns that come in from just these names. And if it wasn't for a couple of those names like Infosys or Adani Enterprises, we would have been up by another 200 points. So they have dragged the index by close to around 200 points. But leave the Nifty aside. The party has been in the broader markets. There's all sorts of Dan, Jai, Bhangra, whatever you want to call it. Mid-cap and small-cap indices, that's where the money has been. No, don't look at only the index. Look at some of these stocks that come up for you on the screen. Frontline F&O names giving you returns of 60% in the first half of the year. Whether you're talking about Oro Pharma, you're talking about Chola Investments, KPIT Technologies, they've given you big returns. But it gets even more exciting if you go, you spread it out and you go to some of those small cap stocks that are a little larger now, because they are up between 100, 150 and even 200% in the first half of the year. Second half is a little bit challenging because we have the monsoon progress, you have state elections that are coming in there. Not sure what the Fed is going to do next as well, and we'll keep an eye out on earnings. But those are the cues we know. HDFC is going to be a crucial one because we'll have a merged entity, so we'll keep an eye out on that. And finally, guys, good start to the year. But in the last 10 years, 7 times when we have had a good start to the year, when we have started positive, the second half of the year has been a little slower than the first half of the year. So this time, first half of the year, 6%. Hope that this data point goes wrong, and the second half of the year, we at least get more than 6%. But otherwise, those 7 instances that come up for you on the screen, all of the times, we've done very, very well in the first half. Well, the second half has been a little bit subdued in comparison to the first half.
There's always room for change, right? And in this first half as well, there was two quarters. Jan to March was horrible. And after that, April to June, you've seen 3 back-to-back gains. Jan to March 3 back-to-back down months, and then April to June 3 back-to-back positive months. In fact, let's invite our guest now on the show. We got Prashant Khemka, founder of White Oak Capital Management, one of India's biggest fund managers, if not the biggest. Prashant, good evening. Thanks a lot for joining us. It's been a party out here. Bull market, of course, defying all conventional wisdom. Promoters are selling stake and the stocks are going up 10%. And how do you read the current situation?
Now, first of all, thank you, Anuj. Always a pleasure to see you and be with you. And today on this special occasion of all-time high, even more so. So as I think you were pointing out earlier, it's been 21 months since we crossed 18 on Nifty. So if you see, it's only 5% over the last 20 months. So in that sense, it is not like a new peak after crossing several peaks in succession over the prior few months. And hopefully you are right, Nigel is right, we'll see those in the months to come. Good to see the earnings growth maintaining its close to mid-teens momentum in 23 and hopefully delivers the mid-teens consensus for next year.
When China occupies such a large portion of the Asia emerging market basket, when there's disenchantment with China, it's a big boost for all emerging markets, ex of China, including India. So, Prashant, you've done some piece about the flows into the emerging markets, China, India. Stack them up for us.
I mean, I'm just going to present newspaper headlines, nothing more, no analysis, no flows, but just headlines, right? And by the way, on that point about disenchantment with China, here's a stunning statistic. I just looked it up on Bloomberg. Chinese mainland markets, the benchmark, is up 14% from the COVID lows. India, this is dollar returns, and India is up 101%, 14 and 101. So I think, it's very clear where the money has been moving to. But let me just go across to the big wall and tell you, the retreat that foreign investors seem to be making, right? I mean, I don't want to make it sound dramatic, but that's what it seems like, at least the indications are. So I just picked up Financial Times is a global, well-respected newspaper, and these are the headlines over the last 2 or 3 weeks that I've pulled up, right? Look at this one. China is cancelled for many foreign investors. Let's look at the next one. Clients rush for Asia investment products that exclude China. Prashant was just kind of hinting at that. Look at the next one. Pension funds recoiling from China, say a Dutch asset manager. Another one, demand grows for Asian investment products that are ex-Japan and ex-China. So this is just the last 2 or 3 weeks, and I could put out many more, but it kind of tells you which way the wind is really blowing. But the question is, why are we seeing the retreat from China? Remember, we've been talking about this China plus one theme, at least for the last 2 years or so. But we've spoken about it mostly from a manufacturing point of view. That, bulk of the manufacturing happens in China, but now we need manufacturing outside China as well. But this China plus one is also true from a flows perspective, portfolio flows perspective, and that's essentially what I'm talking about. But why is this happening, right? Geopolitics and economics are the key drivers here. Economics, we all know. I mean, Chinese growth has been, subpar for some time now. So I'll focus on geopolitics, which I think is the key driver here. For many investors, the US-China tensions are a reminder of the fate of those who backed Russian companies. And we know what happened, right? For companies investors who really backed Russia after the Russia-Ukraine war. I mean, basically investments went to zero. That's a very stark and very recent reminder of what can happen if this rivalry between US and China continues and actually picks up pace. US is actively now trying to reshore, bring investments back into India, back into the US, and curtail the development of critical industries like semiconductors, etc., in China. So, I mean, US, for example, the government passed the US CHIPS Act. We can talk more about that later. US government is considering restrictions on US investments into China, especially in critical sectors. And just in May, we had a statement, an unprecedented statement from G7, the summit, which basically said the intention is to de-risk from China, from chips to minerals to everything. So I think, it's not just the US, it's basically the entire Western bloc. And we are kind of entering a new kind of, multipolar world, which I think at the margin perhaps benefits markets like India. Look at what funds are doing. And again, this is all based on reports that we've picked up. Ontario Teachers Pension Fund cut back positions in China. Sequoia, the global VC giant, split its China business into a separate entity. The famed investor Warren Buffett sold 50% stake in BYD, which is the electric car group. He also bought and very quickly sold a stake in TSMC, which is the world's most important chip maker, because of fears of China. GIC, the sovereign wealth fund, has slowed down its pace of direct investments into China. CDPQ, which manages some $300 billion in assets, closed down its Shanghai office. And of course, I mean, as I said, there is real growing demand, mandates for new Asian investment products that exclude China as a market. Just ending with MSCI emerging market weights, China is 31%, India is 14%. The hope is that if China goes down a couple of percentage points, India naturally will pick up a couple of percentage points, and that means tens of billions of dollars over the next couple of years. This is not a 1 day, 1 week, 1 month story, but it will play out over a period of time. Prashant, just kind of very quickly react to this. How relevant is this a theme in terms of pushing flows into India?
No, very relevant, Prashant, and you've captured it and summarized it extremely well. I think it's basically reflecting what happened in the domestic politics in China over the last 12 months. I would say was building up and culminated in the October-November timeframe when Xi Jinping was re-elected in an unprecedented third term. So China, which was priced closer to or was expected to be on its way to democracy over time, like other countries in the region in North Asia have done over time. So going from single person, China had already moved to single party, and the hope was someday it will become multi-party democracy. It's taken a U-turn, reverse turn, and it has become again a single person led authoritarian country. And that's why what you've seen in global geopolitics, there have been several tectonic shifts that has then had implications for how corporates look at China as a long-term investment destination. That has had implications then how investors look at China. And hence there's been a sort of a permanent, not permanent may be a wrong word because things can always change on every front, including politics, but there has been a structural reset of the Chinese market multiple.
Got it. That's very well put, Prashant. Let's come back to specific stocks and everything. Nimesh, you know, one would imagine with the rally, there will only be upgrades and upgrades, right? But that is not true. There are some downgrades which you've picked up as well.
And that's exactly what I want to highlight. You know, Prashant, we are all celebrating the all-time highs. There is a massive momentum on the upside. But do remember that in many stocks, you know, the run-up has been too fast and too soon. And the re-rating has been like, you know, way ahead of the fundamentals as well. And that's exactly why I'm putting out some stocks where there has been downgrades in the last few days. Now, let me start with the first name. That is Cholamandalam Finance, a fantastic company. You know, a rare downgrade coming from Citi this week. They downgraded the stock to a neutral now. But remember, the stock Y2D is up 56%, and since the March lows, the stock is at 48%. So there has been the upside has been captured. The earnings has been captured as well in the upside. So that's the reason why Citi has downgraded the stock. And they believe after the recent run-up, the stock is now trading at peak multiples of 4.5 times FY25 price to book and close to 21 times EPS. So that's the reason why there was a downgrade on Cholamandalam Finance. The second stock is Paytm. Remember, Macquarie was the first to upgrade the stock at around 400 levels, and now they're the first to downgrade the stock at around 850 levels. So they've downgraded the stock to neutral now. They have a target price of 800. They believe that the risk for the business as well as perception do continue, and there is a big overhang of Ant looking to sell 25% stake in the company. So that's the reason why they've turned a bit cautious as well. The third stock on my list is SBI Cards. While Y2D, the stock is up 8%, but in the last 3 months itself, from the March lows, the stock is rallied close to 16%. Now, Nomura has downgraded the stock to reduce now, and they've cut the target price sharply to 700 versus the earlier target price of 1,030. Now, even for SBI Cards, Nomura believes that the profitability is going to be under pressure, and stretch valuations leaves no room for any error. So that's the reason why the downgrade there. And the last was Narayan Hrudayalaya. Even in that stock, the stock is rallied pretty good. Y2D, the stock is up almost 30%. Even the last quarter, it rallied pretty hard. Kotak has downgraded the stock now to reduce, and they have a target price of 1,000 rupees. And they are now recommending clients to sell into this rally after a big move in the last 1 year. So as I said, there is momentum. We are all talking about all-time highs, but there has been a word of caution as well. I also want to highlight one stock where there has been a consensus upgrade in the last few weeks, and that is Indigo. It's not that the stock is not rallied. The stock is rallied good 48% from the lows, and there is there are multiple upgrades coming in. So Morgan Stanley this week, in fact today itself, they upgrade the stock for the second time in the last 10 days itself, and now they've raised a target price to 3313. So a big upgrade on Indigo. Even UBS has put out a note, and they believe that from here the quarterly results Q1 will be very strong, but that will lay a very strong foundation for FY25, and they've raised the target price to 3,300. Kotak this week added, Sanjeev Prasad has added the stock to the model large cap portfolio, and they have a 150 basis point weight with a target price of 3,000 rupees, and even Citi raised the target price to 2,900. While we are all talking about targets been upgraded or whatever, but do remember there is going to be a overhang, a supply overhang as well. The Ganwal family has been selling stake. They sold 5% in the last 2 tranches. Now they own 29%, and that lockup opens on July 12th. So post July 12th, I guess they can sell further stake. Do remember they are promoters, so only after the quarterly results they can sell stake. But that's going to be a big overhang on the stock. But still, despite a big run-up and an overhang, there has been a massive upgrade across the board on Indigo, and that's something which one needs to point out for.
Interesting there. And just earlier this week, I think Interglobe Aviation's market capitalization crossed that
1 lakh crore,
1 lakh crore mark. We'll slip into a very short break on that note. On the other side, we'll put the spotlight on IT stocks, give you a quick primer on what they could report in their Q1 numbers, and also tell you where the leadership might come in between IT and banks. All that and much more on the other side.
भारत का नंबर 1